All right, let's start with a seemingly impossible financial question.
Okay.
How can a gigantic, really recognizable company file for bankruptcy, report what looks like an absolute death blow in massive net losses, and yet still manage to survive?
And not just survive, but reorganize.
Right. Reorganize and eventually get absorbed by a competitor. We're talking about the convenience store titan Circle K.
Hmm.
They filed for Chapter 11 bankruptcy back in 1990. They were reporting losses in the hundreds of millions. And yet somehow, in the middle of all that financial wreckage, they generated positive cash flow from operations in 1991.
And that single fact was their lifeline.
It was everything. So today we're diving right into the heart of that tension in corporate finance, the huge difference between profitability on paper and having actual, spendable cash.
Yeah.
We're using some key excerpts from analysis on this, specifically from a piece called Cash Flow, the crucial measure of financial survival, to
Yeah.
really understand why one financial statement is the ultimate measure of, well, short-term viability.
And this whole deep dive, it forces us to move beyond the number everyone is taught to focus on,
Net income.
net income, and instead focus on the actual mechanic of survival. So you have to establish the foundational difference right away. It's net income versus cash flow.
Okay.
So net income, you find that on the income statement. It's meant to measure economic performance. It tells the long-term story of, value creation.
How much value did we generate this year?
Exactly. But it relies entirely on something called accrual accounting. So it tracks revenues when they're earned and expenses when they're incurred, which can be months before or after cash actually changes hands.
So net income is basically telling us what we're worth, our long-term health, our profitability based on the economic activity of the year. It's a measure of value, not liquidity.
Precisely. Cash flow, on the other hand, which you get from the statement of cash flows, or SCF, it just ignores all those accrual stories. It's purely cash accounting.
Just the facts.
Just the facts. A simple
Yeah.
report. Where did the physical dollars come from, and where did they physically go? It is all about immediate liquidity. It answers the one question every manager dreads: can we make payroll next Friday?
And that brings us right back to the Circle K paradox. I mean, in 1991, they were the Walking Dead insolvent, huge losses, but they had cash coming in. It's just astonishing that a company so on its back could reorganize, stabilize, and then merge with Marathon Oil.
Yeah.
Okay, let's unpack this mechanism. I have a really hard time wrapping my head around the idea that filing for Chapter 11, the legal protection, actually creates positive cash flow.
Right.
That cash wasn't from, better marketing or selling more Sloopies. It was generated by a legal loophole, wasn't it?
It wasn't generated by the business itself, is cash retained. And that's a subtle but really critical distinction. The positive cash flow was artificial, a temporary result of the court just stumping the bleeding.
Okay, so how?
There were two massive shifts that gave them that cushion. The first one was the immediate, just staggering relief from interest payments.
Interest payments on all their debt, right,
Right.
because they had mountains of it they couldn't service.
Exactly. Before filing, Circle K was just hemorrhaging cash, paying something like $100 million in interest every year.
Wow.
The moment they filed, the clock just stopped ticking on their old unsecured debt. So that cash outflow, it dropped to about $6 million that year.
So they saved, what, $94 million?
A near $94 million hole just vanished from their immediate cash demands.
That is an enormous immediate lifeline. So the company is still technically insolvent, but it stopped the immediate risk of, say, a bank default. It buys them time to negotiate.
It does. But the second factor is often the most counterintuitive one. And
Yeah.
it's fascinating financially. It was the reaction of their suppliers,
Wait a minute.
which led to a massive increase in accounts payable.
Hold on. If I'm a supplier and my biggest customer just filed for bankruptcy, wouldn't I demand cash on delivery? Why on earth would the market suddenly be more willing to extend them credit?
Because of how Chapter 11 bankruptcy law prioritizes who gets paid back. It's all about the priority list.
Ah.
Once the company is protected by the court, any supplier who extends new credit is now placed in a much higher priority class for repayment than all the old pre-bankruptcy creditors.
So they jumped to the front of the line.
They know they're at the front of the line. That makes them much more willing to extend trade credit to keep the business operating. And we saw an $80 million increase in their accounts payable.
So that's $80 million of products and services they got, but the cash stayed in their bank account.
Yep.
So you combine that retained $94 million from interest relief with the $80 million they held back from suppliers. And suddenly, despite catastrophic losses on paper, they have positive operating cash flow.
Correct. The lesson is so vivid. The losses reflected the economic damage of the past. That's the accrual story. But the positive cash flow reflected the immediate ability to survive the present. That's the cash reality. It gave them the resources to pay employees and manage the whole restructuring.
This whole case just proves why the income statement, the celebrated metric of performance, absolutely requires the statement of cash flows as its supplement. Net income can be so misleading.
Deeply misleading.
And we've identified 3 specific high-stakes scenarios where if you only rely on earnings, you will be deceived.
The first scenario is precisely what Circle K faced, but let's look at it in a slightly different context. We call it the big loss scenario, where the reported earnings are actually too pessimistic.
How can a loss be too pessimistic? You're still losing money.
Because a massive part of that loss is often fictional, at least in terms of liquidity. It's due to significant non-cash expenses.
Like what?
The biggest ones are depreciation, amortization, and these things called asset impairment write-downs.
Okay.
So think about a company that built a new factory years ago. This year, they realize that technology is obsolete, or maybe demand for their product just cratered. The accountant has to formally write down the value of that asset by, say, $50 million.
A $50 million loss on the income statement.
Right. It's a painful accounting loss. And it's a necessary reflection of lost economic value.
Yeah.
But did $50 million in cash physically leave the building today?
No, that cash left years ago when they built the factory.
Exactly. So since those paper losses don't use up cash today, the company's operating cash flow might be perfectly robust. It can ensure near-term survival, just like Circle K. Their massive losses were paper-driven, while their cash position was manageable.
So Circle K showed us a terrible-looking company that was secretly, or at least temporarily, cash stable. But what about the opposite? The high flyer that's secretly running on fumes.
Yes.
And that brings us to the second, and I think maybe the most common, failure mode, the rapid growth scenario. This is where earnings are dangerously optimistic.
This is a classic.
Here's where it gets really interesting. You see a company, maybe a celebrated tech firm, a retail chain, and it's accelerating positive net income. Everyone's cheering, the stock is soaring, but that success, that explosive growth, is literally chewing up all their cash.
This is the idea of working capital drag, and I'm telling you, it is the cause of death for so many successful small and mid-sized businesses. To sustain, say, 50% growth, you have to constantly invest cash ahead of when you actually collect revenue.
Right.
I mean, think about what growth requires. Inventory. You have to buy products today, that's a cash outflow, to stock the shelves for customers tomorrow.
And what about sales on credit?
Accounts receivable. You make a sale today, you book the revenue immediately on the income statement, looks great. But if you give your customer 30-day terms, the actual cash only arrives a month later.
So you've got this situation where the income statement is proudly displaying a big sale, but the statement of cash flows shows a massive outflow because you paid for the inventory and you haven't been paid for the sale yet.
Precisely. The profitability is real, but the cash collection lags way behind the need for investment cash. The classic example here is Home Depot in the 1980s. They were a retail rocket ship. Positive earnings, quarter after quarter. But because their expansion was so aggressive, buying inventory, opening new stores, they faced repeated, severe cash flow crunches.
I can just picture the CEO, cutting the ribbon on a massive, successful new warehouse store, and at the same time panicking in the back office because they don't have the cash on hand to order stock for next month.
A success is killing their liquidity. It highlights that vital separation. Net income measures the long-term potential payoff. Cash flow measures your ability to stay alive long enough to actually collect it.
So you can go bankrupt long before the paper profits ever turn into real money.
If you run out of operating cash, absolutely.
That is the ultimate counterintuitive lesson. Financial success can bankrupt you faster than failure if you don't manage the timing of your cash flows.
And that leads us to the third scenario. This one is maybe the most cynical one for investors and bankers. We call it the reality check scenario.
This is when earnings are intentionally iffy.
Iffy or just aggressive. When management has a huge incentive to make the company look stellar, say, right before an IPO, or when they're trying to get a crucial loan, or leading up to an acquisition, the rules of accrual accounting offer some wiggle room.
Right, the flexibility in accrual accounting. So what are some of the aggressive assumptions they can use?
Well, they can stretch the estimated useful life of an asset. That minimizes the yearly depreciation expense, which boosts net income. Or, more aggressively, They can use optimistic revenue recognition policies,
Meaning they book the revenue way earlier than they should.
much earlier than cash collection is even remotely probable. They're basically telling a very favorable and often shaky story about future collections.
That sounds like it's bordering on a legal problem.
It can be, but in the gray area, it's just aggressive accounting. And here's the critical check. While you can manipulate the income statement with assumptions, cash flow from operations is much, much harder to fudge.
Because cash either came in or it didn't.
It's binary. It's real. The statement of cash flows becomes the ultimate reality check on the true quality of those reported earnings. If a company reports skyrocketing net income, but its cash flow from operations is flat, or worse, declining,
That's a huge red flag.
it's an immediate red flag about their accounting assumptions.
And we saw this play out with a company called KnowledgeWare. They were a high-tech acquisition target, but the deal got really chaotic. It almost fell apart.
Because detailed scrutiny revealed that their positive earnings relied on really optimistic revenue recognition and aggressive amortization schedules.
So an investor or a banker looking only at that stellar earnings report would have been completely blindsided. The statement of cash flows, though, would have been the safeguard. It would have instantly flagged that disconnect between the reported profit and the cash actually being generated.
Absolutely.
So let's bring this all back together. What's the fundamental unified takeaway from the tragedy of Circle K, the crisis of Home Depot, and the accounting risk of KnowledgeWare?
The central lesson is always the same. The statement of cash flows is not a replacement for the income statement. It's the vital, mandatory companion.
One tells you about potential, the other about survival.
Exactly. Net income measures accounting profitability and future potential, but cash flow measures the fundamental ability to survive right now. The ultimate insight here, which Circle K illustrates so perfectly, is the old mantra, cash is king.
Right.
But we can add a nuance to it now. Cash flow is the check against management optimism. It is a statement of raw, undeniable reality. For managers, investors, bankers, understanding the actual sources and uses of cash, the liquidity, is absolutely essential for evaluating true financial viability. Without it, you are reading a favorable but potentially fatal story.
And that leaves us with a final provocative thought to chew on the next time you look at a highly successful, fast-growing stock that's being celebrated for its earnings and relentless expansion. After this deep dive, don't just look at the net income. Ask the key cash flow question. Is their operational working capital, specifically their accounts receivable or their inventory, is it growing faster than their cash collections?
That's the question.
Could their massive celebrated success actually be creating a liquidity risk that threatens the entire enterprise before those paper profits ever materialize? That focus on survival, not just profitability, is the ultimate knowledge nugget from this deep dive.
Well said.
Thank you for joining us for the deep dive. We'll see you next time.